Insurance companies don't refuse profitable business unless they know something you don't. On March 15, 2024, Lloyd's of London quietly updated their underwriting guidelines to exclude coverage for what they termed systemic societal breakdown events. Not terrorism, not natural disasters, not cyber attacks, systemic societal breakdown. The language was buried in technical documentation that few people read, but the implications were staggering. The world's oldest and most sophisticated insurance market had mathematically determined that the risk of complete social system failure had become uninsurable. This wasn't an isolated decision. Within months, major insurers across North America and Europe began implementing similar exclusions: pandemic-related business interruption, supply chain disruption lasting longer than 90 days, currency devaluation exceeding 30% annually, government debt default by developed nations, climate migration affecting more than 10 million people annually, all suddenly classified as uninsurable risks. But insurance companies don't make these decisions based on media narratives or political opinions. They make them based on mathematics. Cold, precise actuarial calculations that measure probability and price risk accordingly. When insurers simultaneously refuse to cover specific categories of risk, they're revealing mathematical certainties about future events that their public statements never acknowledge. Insurance markets represent the purest expression of institutional thinking about future probability. Every premium reflects mathematical calculation about likelihood, timing, and financial impact of specific events. When entire categories of risk become uninsurable, it means the mathematical probability of occurrence has exceeded the capacity for profitable coverage. The insurance industry has concluded that these events aren't just likely, they're inevitable. The historical pattern reveals that insurance market behavior provides the most reliable early warning system for systemic economic and social breakdown. Insurance companies possess more comprehensive data about economic relationships, infrastructure vulnerabilities, and systemic interdependencies than any government agency or academic institution. They have financial incentives to calculate risk accurately because miscalculation means immediate losses rather than political embarrassment. During the Great Depression, insurance company failures preceded general economic collapse by 18 to 24 months. Companies like Equitable Life and New York Life faced massive policy lapses and claim increases that revealed mathematical unsustainability long before banks began failing or unemployment reached crisis levels. Insurance mathematics detected systemic weakness that conventional economic indicators couldn't measure. The pattern repeated during the 1970s stagflation crisis. Lloyd's of London and other major insurers began excluding coverage for currency devaluation and political risk events in 1973, 2 years before the worst inflation surge hit developed economies. Insurance actuaries recognized that monetary policy extremism had created mathematical certainty of currency instability that made traditional political risk insurance impossible to price profitably. Today's insurance market behavior suggests systemic risks that exceed anything in modern history. The simultaneous withdrawal of coverage across multiple categories, climate, pandemic, supply chain, financial system, political stability, indicates mathematical convergence of risks that insurance industry models cannot accommodate within profitable pricing structures. Climate insurance provides the clearest example of this mathematical recognition. Major property insurers have withdrawn completely from Florida, California, and Louisiana markets, not because of individual storm risk, which has always been calculable and profitable, because of systemic risk that combines climate change with economic vulnerability, infrastructure decay, and political dysfunction in ways that create mathematically uninsurable conditions. State Farm, Farmers, and Allstate didn't abandon these markets due to environmental ideology or regulatory pressure. They withdrew because their mathematical models determined that the probability of catastrophic losses exceeding company capacity had reached certainty rather than mere possibility. Their actuarial analysis concluded that continued coverage would guarantee company bankruptcy within predictable time frames. The mathematics underlying this decision reveal systemic vulnerabilities extending far beyond weather patterns. Insurance models incorporate economic factors like municipal bond defaults, infrastructure maintenance deferrals, and population density changes that create cascade failures during natural disasters. When insurers withdraw from entire regions, they're signaling mathematical recognition that economic and political systems have become too fragile to support traditional risk distribution. Cyber insurance markets demonstrate similar mathematical recognitions about technology infrastructure stability. Major carriers have implemented exclusions for nation-state cyber attacks, systemic internet infrastructure failure, and cryptocurrency-related business disruption. These exclusions acknowledge mathematical certainty that current digital infrastructure cannot sustain the attack volumes and complexity that insurance models predict. But the most revealing exclusions concern financial system stability. Business interruption insurance now commonly excludes losses from currency devaluation exceeding 30%, bank deposit freezes lasting more than 72 hours, and government debt service suspension. These aren't theoretical risks being managed through pricing. These are mathematical certainties being excluded from coverage entirely. Insurance companies possess proprietary data about economic relationships that reveal systemic fragilities invisible to conventional analysis. Their databases include detailed information about supply chain dependencies, infrastructure maintenance schedules, municipal finance conditions, and demographic transition patterns. This comprehensive data creates predictive capabilities that exceed government intelligence agencies because insurance companies have financial incentives for accuracy. The current wave of insurance withdrawals indicates mathematical convergence of risks that creates systemic failure, probability, approaching certainty. Climate risks intersect with infrastructure decay. Infrastructure problems amplify financial system stress. Financial instability increases political volatility. Political dysfunction reduces climate adaptation capacity. Each risk category amplifies others through feedback loops that insurance mathematics cannot accommodate. Professional reinsurers, companies that insure insurance companies, provide even more sophisticated risk assessment because they analyze aggregate risk across entire insurance industry sectors. Munich Re, Swiss Re, and Lloyd's reinsurance markets have implemented systemic risk exclusions that reveal mathematical recognition of probability relationships that exceed sustainable business models. Reinsurance exclusions for correlated infrastructure failures affecting multiple geographic regions simultaneously. Acknowledge that climate, economic, and political risks have become mathematically linked in ways that violate traditional risk distribution assumptions. Insurance industry business models depend on risk events being statistically independent. When multiple risk categories become correlated, the mathematical foundations of insurance become unstable. The psychological dimension of insurance market behavior provides additional insight into institutional thinking about systemic stability. Insurance companies employ thousands of analysts whose professional reputation depends on accurate risk assessment. These professionals have access to data sources and analytical tools that exceed most academic institutions. When they simultaneously conclude that specific risks have become uninsurable, they're expressing collective professional judgment about mathematical certainty. Insurance company behavior during the Soviet Union's final years demonstrates this pattern with historical clarity. Western insurers began excluding political risk coverage for Soviet trade relationships in 1989, 2 years before the USSR collapsed. Coverage for currency convertibility, contract enforcement, and asset seizure became unavailable through commercial insurance markets, while government officials continued proclaiming system stability. Insurance mathematics detected systemic breakdown signals that political analysis missed because insurance calculations focused on probability of specific events rather than ideological assessments of system legitimacy. When insurance companies determined that Soviet contract enforcement had become mathematically unreliable, they withdrew coverage regardless of diplomatic assurances or political commitments. Modern American insurance market behavior suggests similar mathematical recognition of systemic instability. Exclusions for government debt service suspension, currency devaluation, and systematic infrastructure failures indicate actuarial analysis has determined these events represent mathematical probability rather than remote possibility. The timing of insurance market withdrawals provides critical information about expected timelines for systemic breakdown. Insurance companies structure policies to maximize premium collection while minimizing claim exposure. When they implement exclusions with immediate effective dates, they're signaling mathematical recognition that excluded risks could materialize within current policy periods. Current insurance exclusions suggest systemic breakdown probability concentrated within 18 to 36-month time frames. Climate insurance withdrawals indicate recognition that infrastructure capacity will be exceeded within current planning horizons. Financial system exclusions suggest currency or banking instability within measurable periods. Political risk exclusions indicate institutional breakdown within calculable timelines. Supply chain disruption insurance demonstrates how insurance mathematics reveal economic system fragilities that conventional analysis overlooks. Coverage for supply chain interruptions exceeding 90 days has become largely unavailable because insurance models determine that current global logistics systems cannot sustain the disruption patterns that mathematical analysis predicts. Insurance actuaries possess detailed data about supplier relationships, transportation infrastructure, and manufacturing capacity that reveal cascade failure probabilities invisible to surface-level economic analysis. When supply chain insurance becomes uninsurable, it indicates mathematical recognition that current economic integration creates systemic vulnerabilities that guarantee disruption rather than merely allowing it. The pharmaceutical supply chain provides specific examples of how insurance mathematics reveal systemic breakdown probability. Generic drug manufacturing concentrated in China and India creates single point of failure risks that insurance models cannot accommodate through traditional pricing. When political tensions or logistics disruptions affect these production centers, global pharmaceutical availability faces immediate crisis. Insurance companies have responded by excluding coverage for pharmaceutical supply shortages lasting more than 30 days, because their mathematical models determine this probability approaches certainty given current supply chain concentration and geopolitical tension patterns. The exclusions reveal actuarial recognition that critical medicine availability cannot be guaranteed through current economic arrangements. Food supply insurance follows similar mathematical logic. Coverage for agricultural production shortfalls exceeding 20% annually has become largely unavailable because climate, economic, and political factors create mathematical certainty of significant disruptions to food availability within predictable time frames. Insurance models incorporate data about topsoil depletion, water table decline, fertilizer supply dependencies, and climate pattern changes that create cascade failure risks in agricultural production. When food supply disruption becomes uninsurable, it reveals mathematical analysis that current agricultural systems cannot sustain the productivity levels required for political stability. Energy infrastructure insurance exclusions provide another category of mathematical recognition about systemic breakdown probability. Coverage for power grid failures lasting more than 72 hours has become unavailable in many regions because Infrastructure maintenance deferrals and complexity increases have created mathematical certainty of major outages. The electrical grid represents the most complex machine ever built, with interdependencies that create cascade failure risks that insurance mathematics cannot price profitably. When power grid insurance becomes unavailable, it indicates actuarial recognition that current energy infrastructure cannot sustain the reliability requirements for modern economic activity. Insurance company asset allocation provides additional insights into institutional thinking about systemic stability. Major insurers have increased cash holdings, reduced exposure to long-term government bonds, and diversified into physical assets like gold and real estate. These allocation patterns reveal mathematical assessment that traditional financial instruments cannot provide reliable value preservation during systemic stress periods. The convergence of insurance withdrawals across multiple risk categories, climate, finance, supply chain, infrastructure, political, indicates mathematical recognition that these risks have become correlated rather than independent. Traditional insurance business models depend on risk diversification through statistical independence. When multiple risk categories become mathematically linked, insurance becomes impossible rather than merely expensive. International insurance markets reveal similar patterns of withdrawal from systemic risks across different national jurisdictions. Political risk insurance for emerging market investments has become largely unavailable because mathematical models determine that political instability and economic breakdown have become global rather than local phenomena. When insurance companies simultaneously refuse coverage for political risk across dozens of different countries, they're revealing mathematical recognition that current global economic and political arrangements create systemic instability that transcends individual national circumstances. The mathematical sophistication of modern insurance modeling exceeds most academic economic analysis because insurance companies have financial incentives for accuracy that academic institutions lack. Incorrect risk assessment creates immediate financial losses rather than theoretical embarrassment. When insurance industry consensus emerges around specific risk exclusions, it represents mathematical certainty rather than expert opinion. Understanding insurance market behavior as early warning system for systemic breakdown requires recognizing that insurance companies possess comprehensive data, sophisticated analytical capabilities, and immediate financial consequences for miscalculation. When they simultaneously conclude that specific categories of risk have become uninsurable, they're revealing mathematical analysis about future probability that their public communications never acknowledge. Current insurance market behavior indicates mathematical recognition of systemic breakdown risks that exceed anything in modern economic history. The simultaneous withdrawal of coverage across climate, financial, supply chain, infrastructure, and political categories suggests mathematical convergence of risks that creates system failure probability, approaching certainty within predictable time frames. The insurance industry has concluded that tomorrow has become mathematically uninsurable, not because specific events are impossible to predict, but because the probability of multiple correlated system failures has exceeded the mathematical foundations of risk distribution that make insurance profitable. When insurance companies refuse to cover tomorrow, they're revealing mathematical certainty about systemic breakdown that policymakers cannot acknowledge, media cannot report, and most citizens cannot comprehend. The refusal to insure the future represents institutional recognition that the future has become mathematically unsustainable. Insurance companies don't make political statements. They make mathematical calculations. Their current behavior reveals mathematical recognition that systemic breakdown has moved from possibility to probability to virtual certainty within time frames that make insurance coverage impossible rather than merely expensive. The mathematics don't negotiate. The probabilities don't respond to political pressure. The actuarial analysis operates independently of public opinion or policy preferences. When insurance companies start refusing to cover tomorrow, tomorrow has already become mathematically inevitable rather than merely possible. They know something the rest of us don't want to admit. The mathematical foundations of current economic, political, and social arrangements have reached sustainability limits that make systemic breakdown inevitable rather than avoidable. The insurance industry has run the numbers, analyzed the probabilities, and concluded that betting on tomorrow has become a losing proposition. When insurance companies started refusing to cover tomorrow, tomorrow ceased being a matter of hope and became a matter of mathematical certainty. The only question remaining is whether the rest of us will recognize what the mathematics have already determined, or whether we'll discover the insurance industry's conclusions through direct experience of the events they've determined too risky to cover.